Why are so many stocks moving against the market right now? We've been reporting how stocks are moving way differently than what the index is doing lately. Well, it has to do with concentration levels. Every year has a share of market leaders and laggers. The current gap between AI-linked winners and the rest of the market is especially wide. In fact, an unprecedented share of U.S. stocks has shown a negative beta to the S&P, so negative correlation to the S&P, meaning they have tended to move in the opposite direction from the index if they have negative beta, right? Now, this is the latest sign of exceptionally concentrated market leadership, which has important implications for portfolio diversification. For perspective, historical analysis indicates that the closest historical precedent to 2026 for anonymously high number of negative beta stocks was 1999. Similar to what we are seeing today, the late 1990s dot-com bubble was characterized by extreme market concentration, not valuations. During that period, a handful of massive technology and telecom giants single-handedly pushed the market cap weighted S&P 500 index upward. Meanwhile, traditional brick-and-mortar companies, utilities and value stocks, underperformed or fell in direct opposition, causing their mathematical beta relative to the index to flip negative. Now, looking at realized volatility in high beta S&P volatility, when the two volatility regimes diverge, it results in calmer price action at the index level, as many underlying equities, stocks in the index, experience wild price volatility. This creates a stock picker's paradise, long or short. However, there is also a spicy trade opportunity in the realignment of correlation. The U.S. stock market is, looking fairly stable if we zoom out, with a measure of the overall index volatility remaining at low levels. But implied volatility in single name stocks at the bottom has surged to the highest in more than a year. The gap between the two measures has never been higher. Implied volatility for the average S&P 500 stock is at 40%. Now registers 2.8 times the index's implied volatility, which is also a record. The average single stock volatility usually ticks up into earnings season, which we're in right now. We're in Q2 earnings season, but nothing like this. There's a massive 35 percentage point spread between the VIX for NASDAQ and the VIX for S&P 500. S&P 500 average stock correlation approaches zero. Like we've been tracking the last couple months, we're there at zero now. And it's just like in the late 90s. Many are now familiar with the extreme dispersion implied from the outsized moves and a subset of names versus more subdued moves from the majority of the index, which has seen index correlations drop to around record lows. A measure of 1 month S&P dispersion expectations is at its highest level since 2020, while 3-month implied correlations are just off a record low from earlier this month. But that has some betting on a reversal. Reverse dispersion is still one of our core positions, Chief Investment Officer, Ada Investment Manager says. The classic vanilla dispersion trade is extremely crowded, he said. Implied correlation is effectively flooded at zero, like we just showed. So a trade that goes long implied correlation, such as reverse dispersion, has a favorable asymmetric profile with upside. If correlation reverts to historical mean, on that basis, reverse dispersion is more attractive than the traditional strategy. So we'll kind of go unpack what that means. So the golden high beta momentum index has had its best day this past Tuesday since March 2021. So the high beta momentum index rose by 10% yesterday. That's the best day since 2021 and the second best day since April 2009. So momentum factor gyrations continued this week, and its volatility now registers at the highest level in recent decades, outside of a recession historical path of momentum following sharp rallies. So when we're talking about momentum here, we're talking about stocks related to AI right now, and then heavily shorted stocks as well. So the high beta momentum plays, if we look at this Goldman Sachs basket of high beta momentum, is now down a staggering 33% from its highs. The Goldman sales team, including Ariana Contessa, argues it's the late innings for the momentum unwind. They said the drawdown could get worse if this earnings season or the AI narrative deteriorates more structurally. Okay, so this trend may not just slow down. So what does this mean? What does this mean for us traders? Well, it has to do with crowding risk, because this chart is one of the clearest warning signs I've seen in a while. What you're looking at is the ratio of momentum stocks to minimum volatility stocks. Basically a measure of how much the market is piling into the same high-flying winners versus staying defensive. So the red line is the long-term trend. And every time the blue line has spiked way above that trend, it's marked a major turning point. If you look at March 2000, which was the dot-com top, to June 2008, right before the financial crisis hit, February 2021, the meme stock mania peak, which meme stocks are definitely high momentum stocks, right? So right before growth and high multiple names got crushed in 2022, and then now look at where we're at today. This isn't just another spike. This is a 5 standard deviation overshoot. To put that in perspective, a move in that extreme should almost never happen in normal distribution. We're talking odds of roughly 1 in a few million. That's how stretched momentum has become relative to its own history. Now, I want to be careful here. This isn't a market timing tool. Okay. Momentum can stay hot longer than anyone expects. But what it is telling us is that positioning has become extremely one-sided. Now, a huge share of recent returns is concentrated in a narrow group of high beta names. And historically, when the ratio gets this extended, the unwind, when it comes, tends to be fast and painful for the crowded trade. So the question isn't, is this the top? Nobody can call that with precision. Now, the question is how much of your portfolio's return depends on momentum continuing to work. And are you comfortable with that concentration risk right now? That's exactly why we're going to spend the next few slides talking about rotation and hedging strategies. Because if history rhymes even a little bit here, being early to de-risk beats being late. And that certainly seems to be where fund managers are right now. If we look at the bull and bear indicator that Bank of America does, we can see that we could be at peak levels here. This is going back since 2022 or 2002, I should say. But, this extreme bull zone that we're in right now, we've only touched this level. Let's see. Let me count here. 6 times since 2002. So I guess investors could get more bullish, supposedly. Now, looking at the Russell 2000, we've been trading the IWM recently. There's a widening year-to-date spread between profitable and non-profitable small cap stocks. It's in favor of profitable. Okay. Now, versus last year when non-profitable outperformed profitable, some of the highest momentum stocks have been, related to data centers, AI, of course. Data centers in the U.S. will account for about 20% of the nation's electricity consumption in 2035. That's up from 5.9% today, according to Bloomberg's. Now, there's a lot of hand-wringing about the chart above. It's showing negative free cash flow at hyperscalers. But I wanted to show you that this isn't a red flag. Negative free cash flow isn't a red flag when it comes to have driven by massive AI data center buildouts. It's growth capex with long tail payoff. As long as revenue plus earnings keep rising in these companies, temporary free cash flow drag is strategy and not stress. Hyperscalers' free cash flow has collapsed while free cash flow for semiconductors has skyrocketed to record highs. And this could end up the defining chart of the AI boom potentially. But yeah, there's a major capex squeeze going right now. The spread between nominal and real capex is likely growing fast, the spread between nominal and real capex. Now, if hyperscalers' capex peaks in Q3, like the consensus projections estimate, it stands to reason that the market will reprice many of the AI-related names that have benefited up until now from their past spending. Right now, there is virtually no correlation between hyperscalers and semiconductor companies. We have the semiconductor companies here in the white and then the hyperscalers in the blue. And we can see they're literally doing the opposite of each other. So literally zero correlation. Now, there's a major risk of hidden debt at U.S. tech giants, and it's swelled eightfold in roughly 4 years to an estimated $1.65 trillion as AI investments ballooned, exceeding actual debt and making it tougher for investors to assess risk. Now, it was examined that recent financial statements and other materials from Google and Microsoft, Amazon, Meta, and Oracle, 4 companies aside from Oracle are scheduled to announce their second quarter earnings from Wednesday, meaning the figures may increase further. The 5 companies' hidden debt, which does not appear on balance sheets, totaled $1.65 trillion in the most recent quarter, exceeding the roughly $0.35 trillion in debt reflected on their balance sheets. The data includes some estimates. So here we can see Meta actually has the most off-balance sheet future obligations here at nearing 1.5 trillion. So this chart is in trillions, right? And Meta is the majority of the 0.6 trillion here on the chart. But Meta and Oracle are the biggest ones here, and Alphabet. That's interesting. So that's definitely a headwind, I would say, for markets right now. Now, as a follow-up to the last slide, on-balance sheet hyperscaler leverage is rising. So the mean of enterprise value versus market cap for hyperscalers here. And the on-balance sheet hyperscaler leverage is above 1 trillion now. So is there demand for semiconductors? But is there demand moving forward for semiconductors? Well, South Korea's exports is a good indicator to see if that's holding up or not. And their exports extended robust growth in early July. AI-driven demand for semis continued to fuel the economy. So exports adjusted for working day differences climbed 62%, so almost 63% from a year earlier in the first 20 days of July. Chip exports climbed 180% from a year earlier. Shipments of computer-related products increased almost 232%, while fuel exports gained 33%. Now, since we're on the Korean theme, the South Korean ETF EWY, which we've traded in the group, has attracted more than 2.8 billion in inflows last week. That's the largest intake ever. This has surpassed the previous weekly record by 1.6 billion. This is also the equivalent of 12.5% of the 22 billion fund assets under management. Meanwhile, EWY, so the ETF, dropped 11% last week, the third largest weekly drop in 2026. The fund is now down 25% as the South Korean market goes through a bear market. So yeah, it's down 25% from its high. But year to date, it's up about 150%, which is crazy. Now, I was showing you guys in past presentations that Korean traders are extremely leveraged as of late. A lot of them are going into debt so they could hopefully get some profits in the stock market on a leveraged basis. And because they were so leveraged, a lot of these retail investors, the ants, I like to call them, or at least the Koreans call them ants, since there were so many ants that were leveraged traders, a lot of them ended up having to unwind leveraged stock bets. So now Korean traders' leveraged stock bets is at its lowest level since April. Okay, so we're seeing a little bit of a shakeout, which could be good. It may be why we're starting to see more inflows into the Korean market again. Now, if the reversal in semiconductors continues, we could actually see a flow back into gold and Bitcoin. The cumulative outflows from US listed gold and Bitcoin ETFs this year was 17 billion, are almost the same as inflows into semiconductor ETFs. Now, it's quite conceivable the retail crowd, now a far from insignificant driver shorter term trends in the market, jumped out of gold and Bitcoin into tech hardware earlier this year. Now, with the downturn in semiconductors gathering pace, where will those funds go? Now, a strong candidate is gold and perhaps Bitcoin. The semiconductor index has now entered a bear market, and this is the US semiconductor index. It's down 20% from its all-time high. So it's interesting. High correlation between this US semiconductor index and the Kospi, right? Kospi is mostly consisting of semi companies. So they're down 25%. We're down 20%. So the semi index is even down in a bear market in the US. Now, ran some numbers, and only once in 2018 did the drawdowns in a semiconductor index not extend to at least 35%. Now, that said, overall things have been much more favorable post-2000, with only one instance, 2022, now representing a great buying opportunity for a 12-month hold. Now, whatever happens, history says things won't get any less volatile anytime soon in this. Despite the sell-off this month, Deutsche Bank notes that accompanying tech funds saw huge new inflows over the last 6 weeks, 71 billion, of which 50 billion was into semiconductors, compared to 20 billion in the rest of tech, and 20 billion into other sector funds combined, pointing to strong underlying demand. But as this boom in inflows gets unwound in the face of ongoing negative catalysts, it is likely to extend the sell-off, with investors balancing the surge in earnings against questions about its likely duration. So yeah, with the recent drawdowns, momentum has now delivered weaker returns under Trump 2.0 than a strategy of buying the most heavily shorted stocks while shorting the least. So this could mean trouble for quant managers that have a systematic trading strategy, right? Rather than just trying to trade the most heavily shorted stocks. So basically the opposite of what quant managers would want to do might actually come to fruition here soon, just based on the momentum action. Let's talk about Gamma real quick. It's the option mechanics for dealers, and that heavily influences the market. All right, so there's a 7,300 level, which would be a 2% move down where we are right now. It's identified by Bank of America, the 7,300 level, around the threshold to flip more heavy selling. Also happens to coincide with the estimate of gamma flip points to negative, okay? So this is where dealers would further add to any selling below 7,300. So that becomes an important level this week. To the upside, gamma builds until 7,650 level, which would keep rallies more subdued until that point. Overall, the estimates are in lower gamma environment as volatility is insulated due to options expiration, which they say release nearly half of the options positioning. All right, so that's it for the slides. Let me go through what I'm going to cover in actual trades here.